Good afternoon, everyone. I think we are ready to go. Welcome to today's event, which is part of a series of McGill-wide virtual events on many issues, including the pandemic. My name is Chris Ragan. I'm an economics professor at McGill, and I'm also the director of the Maxwell School of Public Policy, which is a new creation in the last couple of years. I've got two great speakers with us today who actually happen to be former students of mine. The first is Danielle Goldfarb, who is a BCom from 1997. She is the head of global research at Reawy Corp, and I'm going to get her to explain what Reawy is all about. She's an expert in global trade and emerging technologies and the global digital economy. And before Reawy, she spent some time at different think tanks, economic think tanks in Canada. That's Danielle Goldfarb. The other guest is Sylvain Leduc, BA from 1991 and an MA from 1993 in economics. He's now the executive vice president and the director of economic research at the Federal Reserve Bank in San Francisco. And from 2016 to 2018, he was a deputy governor at our very own central bank, the Bank of Canada in Ottawa. I'm going to ask each of them, just so you understand the world that they come from, I'm going to ask each of them to give us a 30-second quick treatment of what their organization does. So Sylvain, let me start with you. What does the Federal Reserve in the United States do in 30 seconds?
30 seconds, okay. So we're responsible for monetary policy, financial stability, supervising the banks. The system is very decentralized, and so here my responsibility is to brief the president of the bank, being responsible for all the key research inputs that go into monetary policy making.
Okay, thank you. And I'm just going to suggest that while each of us is not talking, we mute our microphones. I think there was some feedback there from Sylvain.
Yeah.
Danielle Goldfarb, what does Reawy do?
So Reawy stands for Real-Time Interactive Worldwide Intelligence. So we're basically active in every country of the world, measuring public sentiment and behavior in real time. And we're using a technology that is able to get access to opinion from the broadest set of the population, including people that are not typically answering surveys, who aren't typically on social media. So we can really get access to what the majority of people are thinking and feeling about this pandemic situation. And I should just also add that the technology, the Canadian technology, was actually developed for a different pandemic. It was developed for the H1N1 pandemic to understand how the public was responding to that pandemic. And right now, we are now using the technology around the world to monitor in real time how consumers, workers, and others are responding to all aspects of the situation, including the economic shutdown and recovery.
Great, thank you. So Danielle and Sylvain and I had a conversation a couple of days ago to agree on an approximate agenda for this conversation. So let me just set a bit of a stage. Whether you think about Canada or the United States, or frankly, pretty much any other country you want to think about, we are 10 weeks roughly into our version of the pandemic. Different countries are at different stages. But we are in the middle of the second quarter in economic terms, the middle of the second quarter of 2020, and we are probably in the depth of the economic decline. The data won't come out for a while, but we are anticipating that by the time the second quarter is done, by the end of June, I suppose, GDP, national income, the level of economic activity, will have fallen by something like 25% from the previous quarter to the second quarter. That is an enormous decline. It is a super quick decline. It is a deep decline. And even if the economies were to recover almost immediately in the third and fourth quarter, it would end up being an annual decline, probably bigger than anything we had seen since the Great Depression. And if the recovery is much slower, if it takes 4 or 5 quarters for the economy to get back to its pre-pandemic trend line, then the impact on the economy is even larger. So we are talking about a huge economic hit. That's the first point. The second thing is that it's been a very different kind of economic contraction or recession. It hasn't been one caused by a lack of confidence or one where households and firms just decide they don't want to spend. It's been a intentional lockdown of economic activity created by the need for people to basically stay at home and self-isolate and therefore not produce. And so if we are not producing and not working, then there's not production going on, there's not income being generated. And it's very much an intentional, an unfortunate act, but an intentional act designed so that we can then address the health aspects of the pandemic. So that's a very different thing. And the final thing I will just say in setting the stage is that governments around the world have responded in broadly similar ways by basically issuing a huge amount of debt so that they can provide income relief to individuals, income relief, or possibly in the form of credit assistance to businesses. Basically, government programs have been designed to build a bridge in terms of their revenues from 10 weeks ago until whenever it is that they return to work. And so the IMF, the International Monetary Fund, has recently projected that government debt in the G20 countries will increase by something like 15 percentage points of GDP. 15 percentage points of GDP. That's a huge increase in public debt that happens basically in a year or even less. Now, those are my comments in terms of just setting the stage. What I'd like to do is go to our local central banker here, Sylvain Leduc, and ask what role have central banks played in helping the governments to finance what's going on, and what else are central banks doing? So you can talk about the US Federal Reserve, but you can also talk about other central banks that you follow closely. Thank you, Sylvain. And then we have to demute you, Sylvain.
Okay, good.
There we go.
You wanted to keep me muted. Good. So let me focus a bit on the Federal Reserve, but I think it's indicative of what other central banks have been doing. The first thing we've done when we had early signs that economic activity would rapidly slow down was to lower interest rate to essentially the zero lower bound, the effective lower bound. And so we were at the effective lower bound back in 2008. We emerged from that in the mid 2010s, and now we're back at it. So that's the first thing we did. The second thing we did is that we intervened fairly heavily in financial market, and that's because the uncertainty around the virus, the evolution of the virus, and the impact on the economy was just so high. I mean, we've seen measures of uncertainty first jumping, doubling a little bit, but then by the end of March, jumping to levels that we hadn't seen since the Great Recession. So that was really concerning. We saw malfunctions in certain markets, particularly even the Treasury market, and this is where we get a little bit more concerned. So what was happening basically is people were so uncertain. There was a flight to safety, and we've seen even safety not even in treasuries but in short-term treasuries. So people were even dumping long-term treasuries and bought short-term ones. And so we were trying to lower rates, but at the same time, because of those actions, we saw long-term yields going up. So the first thing we've done is that so that our policies could be effective was really to make sure that markets were functioning properly. And I think you've seen those types of action around the world. So it's really what we've been about right now, really making sure markets function well.
So let me ask you this, Sylvain. Is this because once central banks start printing money, which of course they have always done through history, but massively expanding that activity, and buying government bonds in huge amounts with basically freshly printed money, some people start talking about the concerns of inflation. So is inflation something that we should be worried about in the next year or 2 or 5? Or are these actions from the central bank, are they reversible? Should we expect them to be reversed at some time in the near future?
Right. All right, so let me make a few points on this because that's really important for central banks, especially those that are targeting inflation, like we are at to some extent at the Fed, since we have a dual mandate. So the first thing is this shock is interesting because it's both a supply and a demand shock. So we have restrictions on supply that would tend to make prices go higher, and so you'd see higher inflation. At the same time, you see big declines in demand, and this tends to be disinflationary. And I think overall, the biggest impact is going to be the latter. So we should see disinflation for the short term, for the medium term as well. And I think you see this being priced in financial markets. So if you look at the break-even rates, so when you compare long-term treasuries in nominal versus real terms, you see that these compensation for inflation has just gone down tremendously. So my sense is that we're going to be in a way where there's going to be a lot of uncertainty. There's going to be people are going to save more, consume less, and that's going to be disinflationary overall. And so I'm more concerned of living in a world where we have below inflations for a long time. And so to your other point, the concerns about inflation were there also when we started doing QE back in 2009, 2008. And what you've seen, a lot of the facilities we've done, they were removed after when the height of the crisis peaked. We removed those facilities, and we've tried to shrink the size of the balance sheet. In fact, you go back in September, and we thought our balance sheet was too small, giving our desire to operate in a larger balance sheet framework than we had in the past. And we don't have that problem anymore, of course.
Right. Yeah, it requires a pandemic to just reverse that problem. Okay, well, let's actually turn to the recovery. Many economies are now starting the process of restarting their economies. They, of course, never shut down completely. But let me go to Danielle and ask, I suppose, because you are watching data every day, and some of that data is, I think, unconventional data to kind of traditional macroeconomists. So what are the signs of a recovery, Danielle? What are the things that we should be looking for? Should we be looking at the sort of normal data that we always look at, or is there some sense in which we should be looking at different kinds of data now?
I mean, I think there's a lot of different things that we need to consider just because this is a completely unique situation. The first is the timeliness of the data that we use. We're used to, labor market data that comes out weeks and weeks after it actually occurs. We're used to really, seeing consumer confidence data that maybe comes out at the end of the month. And we're really in a situation now where, we have to monitor these kinds of things on a daily and weekly basis because, we don't know, the public health directives came out in the middle of March. You can't sort of just say, well, we'll wait till the end of March and then kind of, see what's happening. You've got to be able to monitor in real time what's truly happening. And so a lot of the data that we're looking at now is trying to look at, what happened this week, what happened in the last 2 weeks as we started to reopen our economies. Did people get rehired? Do people feel comfortable going back to work? Are people going to start shopping again? All those kinds of questions, which are getting at both the sort of real-time behavior, what are people's are they going back to work, right? Are they going back to work? Are businesses reopening? And then also sort of the psychological aspects. So do people feel safe going back to work? As a parent, do I feel, do I have confidence and trust that, my kids will have childcare? Those kinds of things that are not ones that we typically think about, I think, when we're talking of a traditional, certainly not monetary policy, but sort of the suite of policy tools that we have to think about a whole different range of tools. And I can share some of the data that we're gathering in real time if people are interested as well.
Well, if you've got, I know you've got a couple of slides that you may want to show us that are some interesting developments in the labor market. Do you want to show those now?
Sure. Yeah, if I can just share my screen to do that.
We learned how to do that 5 minutes ago, 10 minutes ago. Oh, there we go. Excellent.
Am I sharing my screen? Hold on a second.
It
One
worked for a
second.
brief moment.
Hold on a second. Here we go. Can you see this? Can you see this chart now?
Not yet.
Aha. Okay. Hold on one second.
There it is. That's very
Okay.
nice. Oh,
Here it is. Okay.
talk us through
So
that
yeah,
one.
this is an example of some of the data that we're gathering in real time. So the data, the official data that comes out, the last official data that came out in terms of what's happening in the Canadian and US labor markets was referencing the week of the middle of April. But of course, we're now heading into, in most parts of North America, we're heading into this reopening period. So we're really tracking on a daily basis, and we're asking you know, a random, continuous random group of the Canadian and US population on a daily basis, the same question, you know, what is your working status? And what they consistently told us is during this sort of April to May period when we're still in shutdown, that about 1 in 5, and in some cases more than that, of them were unemployed. And that's very, very, you know, that's extremely significant. But as we head into this reopening period in the last 2 weeks, people started to, you know, perhaps get rehired, and we're actually seeing a larger share of the population that is employed full-time. So people who've moved from part-time status into full-time status, and also people that have moved out of the unemployment category entirely. So we're starting to see these early signs, and I think early signs of reopening and what the shape of the recovery is going to start to look like. But of course, these are just still the early weeks of this recovery period in North America. And, you know, so it remains to be seen what happens in June. And the next couple of weeks are going to be really critical to watch.
So 2 comments on this. Doesn't look like much of a recovery yet.
That's right.
And it's worth pointing out that unemployment rates in the United States and Canada before this started were, you know, something like 5 and a little bit in Canada, and probably below 4 in the United States, I think. Is that right, Sylvain?
Yeah, yeah.
So this is an enormous increase in the unemployment rate. The other thing that's worth pointing out, and it's not in this chart, but Danielle, maybe you can comment on this, that the drop in employment in the past 8 or 10 weeks has been larger than what you see in the unemployment rate, because a lot of people have actually dropped out of the labor force. And once you drop out of the labor force, you don't show up in this data. So do you have a comment on that, or is that interesting? Is it just normal?
Well, I mean, there's no jobs to be had, so why would people be? I mean, the traditional way we ask this question in official statistics is we say, you know, did you actively look for a job last week? There was no actively looking for a job last week. I mean, people did. First of all, we're trying to encourage people to stay home, and second of all, there were no jobs to be had. If you were laid off, you know, there was nowhere to look. So, if you read the fine print of the official data that came out in early May, with reference to the mid-April period, basically said, you know, something to effect of, you know, add 5% to the official rate that came out. If you read sort of further down in the release, so you know, unemployment rates were really much closer to, you know, 17–18%, which is actually, you know, and our data actually shows that they're even higher, because our population is actually, we're actually going out to a broader set of the population, so we're capturing maybe even more.
Yeah, I'd say, you know, like on this, it's interesting because there's been some work done on that, and there seemed to be early retirement going on, and there are multiple forces happening right now. Like, you'd think that the hit to wealth would give incentives to people closer to retirement to maybe stick around a little bit longer to replenish their nest eggs. But you know, this is a crisis that's impacting their lives very directly, and so the risk of getting sick, I think, makes people reconsider going back to work. And so you might, what we're looking at is whether this drop in in the labor force and the participation rate is going to be transitory, or are we going to see something more permanent?
Well, and on top of that, so the the probability or the possibility of becoming ill may keep people out of the workforce, but at the same time, a lot of financial wealth has collapsed in the last 3 months, and so some people that would have been on the edge of retirement may be deciding that they can't afford to retire and they need to work for a few more years until those markets recover. So I remember sitting around the round table where I have lunch in the McGill Faculty Club after the 2008 financial crisis started. There were a lot of people that stayed on teaching for a long time. They're still there because they didn't want to retire because their pensions had just taken a hit. Danielle, did you want to show us another slide?
Sure, I will, if I can be granted permission to share the screen. I was just going to also mention that we are collecting data on, can you see this screen now?
Yes.
So we're collecting data. So in addition to job loss, we know that not everybody has a traditional job, right? That they're working kind of a standard job for an employer. That there are many people who are working gig economy type jobs, and there are many people who lost working hours, so their hours were cut back and so on. So when we ask this kind of question, asking people, what's the impact on your income, we're actually seeing impacts that are much more serious, even more serious than the very serious unemployment or employment data show. So this is, and then I would also add that this is actually, when you break it down by age category, you can kind of see that the impact on young people, and this is of a major, you talked about the incentives on the retirement side, but now we have this issue of this generation of people who are graduating from university, about to graduate or just graduated from university, or at the beginning and early stages of their career and entering the labor market at a very difficult time. So this is another thing that we really want to monitor, is the impacts on these particular groups of the population as well.
These two slides really speak to the nature of the government policy response, because when you have such a large fraction of the population that is losing such a big chunk of their income, even if it's only for a month or 2 or 3, and hopefully it doesn't go on much longer, then that explains why the dominant government policy response has been basically to give people money. And they've done it in different ways. So whether it's basically cash in your bank account, which is one of the policies that the Canadian government has used, and other governments, or whether it's a wage subsidy to firms that then gets passed on to workers, it really speaks to the nature of the policy response, because it's not economic stimulus in the traditional sense. It's not trying to increase activity. It's not trying to get people back to work. Quite the contrary. It's trying to fill a financial hole while they are stuck at home. On those data, Danielle, did you have any gender split? Because early on in this pandemic, we were hearing that women were disproportionately affected in terms of income loss and employment loss. And then later I started hearing that maybe it was actually closer to balance than we thought. But do you have any gender split on that data?
We do. I mean, the official data do show that, earlier on in March and April, in February and March, the initial round was hitting women harder. Then it kind of evened out. And then I guess as construction and manufacturing, as some of those more male-dominated industries start to reopen faster than perhaps, retail and restaurant and some other sectors where women are more likely to be employed, we're going to see a differential impact in terms of the recovery. One of the things that we saw, and we have to dig into this further, is that actually we saw some evidence that women had actually dropped out of our looking to work category recently and into the sort of just unemployed category. And we have to look into it further, but obviously there's this childcare aspect. We have everybody at home. My kids could burst in here at any moment. We have everybody at home, really kind of struggling with the situation. The schools are closed, camps are canceled, You know, so that may have a big impact on women's labor market decisions as well going forward. But yeah, all our data, lots of gender split as well, lots of gender.
Okay.
And we have data on, I was just about to say, we have data a bit now, high frequency, on how much people are spending, how to transfer to receive, at least in the US. And the impact is pretty large. So people are spending up to close to 40% of what they're receiving very quickly. And as you would guess, people that are more liquidity constrained are spending way more. So in that sense, in that kind of bridging the gap, it's having a positive impact.
Yeah, I was going to say that actually aligns with the data we're seeing in the U.S. and Canada, that people need the data. They plan to need the data. They need the data, but they plan to spend the cash, the extra cash that they're getting from governments. They plan to spend it on day-to-day necessities. They need it. You know, they need it urgently, and many Canadians and Americans are living, you know, paycheck to paycheck, and so this is really. You know, this is really it's really important right now to fill that gap.
A few minutes ago, I was asking what a recovery might look like, and part of you know, a recovery is a forward-looking question, and a forward-looking exercise that economists do is to make forecasts. Now, one of the things that's happened, for example, in Canada, we were going to have a federal budget in the third week of March. That seems to have simply disappeared into thin air. Presumably one reason is because in order to do the budget, you have to make a forecast, and the forecasts are now more difficult to make. Even the Bank of Canada, Canada's central bank, I think is now publishing different types of forecasts. So I want to come to Sylvain and ask, how do forecasts usually work? Okay. And why are forecasts usually tough? But what is it today that makes them so much tougher?
Well, I think typically they work with error bands. That's the first thing to know. They're precise in good time, and they're much more so now. I think the main, so first, in terms of monetary policy, fiscal policy, you need the forecast because policy works with a delay. And so you need to know where the economy is going to be in a year or two, so that you can fine tune the policy today more appropriately. So that's the first thing. The second thing is that forecasts, you know, we're often relying on data to tease out where the economy is going to go, and you know, there are patterns in the data that we can work with. With a virus like this one, that's the problem. We just don't have episode to go back to. You know, we could go back to maybe Asia. There's about 5 epidemics we could go to over the past 20 years or so, but that's still not telling you a whole lot about the US economy or the Canadian economy. You could go back in history, and people have done that, but you know, if you compare the Spanish flu of 1918 to what's happening now, clearly things have changed. We're not dealing with the same economy. And so that makes it very difficult to have a modal forecast, to think about probability. What's the probability a second wave occurs? What's the probability that the social distancing measures work? We don't quite know. So I think in an environment like that, and I completely support what the Bank of Canada has done, thinking in terms of scenarios make a lot more sense to me than putting out a modal forecast. It's really useful, I think, for policymakers to think about the downside, in particular in an environment like here, where you have you may care a lot more about the downside than the upside, just because of the constraints, for instance, on monetary policy. So you want to know what your downside is, and thinking about scenarios like that, alternative ones, is very, very useful. And so, just like the Bank of Canada, the Fed here, as you know, we have survey of economic projections that we conduct a few times a year, and in March it wasn't done because the uncertainty was too high. And the last time I think this was the case was following 9/11. And so, a situation like this, we'll have an SCP round, we'll have economic forecasts. All the policymakers will provide forecasts in June. But I'm sure they'll know the high level of uncertainty behind them. So I don't think we'll do alternative scenarios. The alternative scenarios are always done, but they accompany a modal forecast. So this time around, I think they'll try to do a modal forecast. Maybe people will talk about, you know, different scenarios they have in mind. But so as we get more information, I think you'll be able to have a better sense of where the economy is likely to go, and at least remove some of the scenarios.
Danielle Goldfarb, does Reawy get into the dark art of forecasting, or do you just stick to the facts?
So, I mean, basically, because we're measuring both the real-time behavior of people and also their psychology. So whether they think now is a good time to go out and buy things and so on. We actually are in the prediction business, right? So we're really able to say, okay, so for example, we're asking people right now, is now a good time to make a major purchase? Are you planning to go out to restaurants this week more than you did last week?
Right.
For women, are you planning to buy, of the things you could buy? We're monitoring to see how many of them are planning to buy new clothes, which is a sign of, whether they're going to be going out to work. So those kinds of things, we are monitoring many of those things, and we're looking at how they're changing over time to see whether we see points where there's like an inflection point. We're not doing GDP forecasts, but a lot of the data we're gathering could be important inputs because we're gathering these psychological aspects that are very, very difficult to model. And particularly difficult to model when we think that they may change during different phases of this recovery period. So, maybe people are feeling optimistic in the early days of the reopening period, but then as we get further along, depending on their trust in the public health situation, that may change. So we have to really, I think the key thing that is important, I think, for forecasters is really to be constantly checking. Everybody has these pronouncements about what's going to happen when we reopen and what is going to change and what's going to stay the same. And I think the key thing is to recognize that we have to constantly check those assumptions against the data to see what's truly happening.
Danielle, have you landed yet personally on kind of your favorite metric for optimism? Like, is it, the percentage of I don't know, men who say they want to go out and buy a new lawnmower, or the percentage of women who say they're, I don't know, they're going to go shopping, or, is it?
I wish I could say I
else?
know what the magic the magic one is, the magic question is. If anybody who's watching or any of the two of you have a magic question that we should be asking, I would value that. I can tell you the kinds of things that we are, so we are monitoring, people's views about, their personal situation, whether they think their own financial situation is going to improve, whether it's going to worsen, what they think is going to happen in the economy overall, because those two things can differ. You might think that you yourself are at risk of losing your job, but the economy is going to do fine, or vice versa. So we're monitoring those kinds of things. I think the other thing is we're monitoring things like pent-up demand. So, the degree to which so we're asking a question now, so as the economy reopens, what is your priority for spending? And really what we're not necessarily monitoring is exactly what they're going to spend on. We're actually monitoring the people who say they're not planning to spend on anything. And we're going to monitor how much that changes day to day and week to week in the coming weeks. So it's really looking at what's not changing. And the other thing that's kind of interesting in China, which we're looking at because it's now a couple months ahead of us, we're actually looking at those people who don't know whether now is a good time to spend or not. And we're looking at how the share of those people who don't know is changing. So really what we're looking at is how uncertainty is changing, the degree to which people are feeling very uncertain. And what we're seeing now in China is very interesting, that people are more uncertain now during the reopening phase about whether it's a good time to make a major purchase than they were during the trade war period. We've been tracking this, since 2018. And so we're in, this is kind of a very important thing to be looking at. The economy is reopening. They basically returned to sort of semi-normal kinds of activities. Yet there's still quite a bit of uncertainty about what is the right, whether now is a good time to go out and buy things and so on. So yeah, and I will also just mention that one thing that's really, really different now is that we're living in a very digital economy. And so we can't necessarily look at the same kinds of indicators. So if we look at pollution levels, for example, which is one of the high frequency indicators people are looking at to see whether we're recovering, we're not capturing, the fact that people are working from home, that people can be buying things online. We're not capturing a lot of these kinds of things. And so we have to look at a lot of these psychological kinds of indicators. to get a sense of what is truly happening.
Cool. Okay, let me. I want to ask each of you one quick question before we turn it over to start looking at the Q&A from the audience. And this is the forward-looking question. So, looking beyond the next 3 months, beyond 6 months or 12 months, is there something you're concerned about in the longer run? Is it the changing role of government? Is it some trends that you think might be, that might happen that we should be keeping an eye on? Sylvain, what's one longer run concern?
Yeah, I think for me, I think the crises for sure in the US and some other countries basically highlight the interconnectedness of everyone, and like this sort of externalities that are running around, the spillovers from behavior from individual to the whole community, the community to the nation as a whole, and the importance of public good really. And I think we've skimmed on spending in terms of public good. Infrastructure spending is one of them. It's well known, at least in the U.S. But more than that, healthcare as a public investment here has been much lower than in other places. Education is another one, and you think about the digital divide. We think often it'll be easy, people can work from home, or they, even applying for unemployment insurance online is very challenging for many people because they might have Wi-Fi of a lower quality with a certain limit. So the digital divide is playing a big role in this crisis. So investment, I think public investment would be really warranted in those areas. And I'm hopeful, but at the same time, I think it's bimodal. I think we could see people rallying up and being concerned about small probability events with big consequences, like we've just seen, or it could go completely the other way. And I'm not, at this point, I don't think we're sure how it's going to play out.
Well, it'll be interesting to see if in the United States and in other countries, if we actually do have at least the debate about priorities. Will we have a debate about the need for greater public infrastructure spending or public health spending? Fundamental debates about the role of the government. It'll be interesting to see if we have those. Danielle, how about you?
Yeah, well, I would agree broadly with Sylvain's point that the crisis has exposed a number of these policy areas that we should have probably paid much more attention to in the past, but are now becoming like acute problems. And so we have to kind of we have to really address them. If you don't have paid sick leave, for example, then people will go to work when they're sick, and then we'll have other outbreaks and so on. So there's lots of different kinds of different areas that need to be addressed now. I would say that one concern I have, and one thing that we're actually looking at, is this question of whether, and this is sort of related to Robert Schiller's narrative economics thesis, this idea that if people believe things are actually going to be, things are a lot worse than they are, then that can actually perpetuate and deepen an economic crisis. And so so that is, I think, something that's very important. Again, it's a psychological thing. It's not that easy to model or to measure. But as we go forward, are people going to be so fearful that the consequences of this are going to be deep and severe, that's going to lead to a deeper and more severe consequence than we might otherwise have? And so we may want to think about, as we go forward, even the sort of the messaging that policymakers use, that either reinforce or don't reinforce those kinds of attitudes. So that's a deeper, longer term concern.
The economics of self-fulfilling prophecies is very important stuff. Okay, I'm going to turn to some questions that we've received from the audience. And I'm going to ask the first one to Sylvain, because Sylvain, in some of your comments, you talked about savings rates. And this question is about the impact of the pandemic on people's ability to save, either their ability to save or perhaps their willingness to save, either for a rainy day or for retirement. So what have you noticed, what have we noticed so far in the data about savings rates? And what do you think we are likely to see in the future on that?
Yeah, I think in the data following the Great Recession, you saw a pickup in savings rates. You know, some people have more ability to save than others, and then we're back to the discussion on inequalities. So it's difficult if you're making minimum wages to save, of course. But nonetheless, I think you've seen this around the world, and this is one of the factors contributing to lower real interest rates. And so I think this is likely to continue as people are more afraid, more concerned about the future, whether they'll be employed or not. I think we'll see a greater desired saving rate, and decline, pushing down interest rates, basically.
Can I just add that we actually asked this question in the past week. We asked people whether they plan to spend, to save more or less. And in the US, about 45% of our respondents are saying that they will save a lot more in the future. This is over the last week. So people are already, that sort of confirms what Sylvain's hypothesis is. So far, at least. We'll see if that actually turns into reality.
Right.
Okay, I just lost. Can you hear me, both of you?
Yeah.
Okay, I lost my audio there for a moment, but you didn't notice and you just kept on going, and that's fabulous. Danielle, I've got a question for you that also came from the audience about it's really about trade between Canada and the United States. So the question is about if the United States continues to focus on making, you know, America great again, and starts to look more inwardly in terms of its production facilities, how should we be thinking about this in Canada, and what kind of a threat is it economically for Canada?
That's a good question. I'm not sure if I have a full answer to that. I mean, as everybody in the audience knows, Canada and the US are highly integrated from a production perspective in terms of us basically making things together across our shared border. And so already there's been, you know, huge disruption, making things together, but also creating things together, both in terms of, you know, products and services integrated. And so already there's been huge disruption to our relationship, and I certainly imagine that businesses are reconsidering the way that they plan their production processes in ways that you know, they were forced to do in the post 9/11 period when they were shut down at the border and so on. So you know, all that to say is that, you know, I think that does make Canada a less attractive investment destination when companies are setting up, if you know that you can't safely get across the border, and that could have implications for Canada. I mean, we're already seeing big implications on this sort of the question of sourcing medical supplies globally, where there's been protectionist actions taken. Although, you know, and that's very important to be able to keep those connections going. So there could be important implications. As to what Canada should do about that, I'm not sure I have the answer. Maybe one of you has the answer to that question.
But you know, Chris, this is accentuating most likely a trend that we've seen over the past 10-15 years. The Bank of Canada has documented very thoroughly how Canada's lost market share in the US since the mid-2000s or so. And so most likely we've seen stabilization in global value chain growth over the past 5-6 years. I think this is all going in the same direction, retrenchment in terms of trade.
But one of the interesting things we hear about is because supply chains got so disrupted in this, well, across the world, they've been disrupted. There's been discussion about the need to bring supply chains into the country, to domesticate our supply chains. And I'd like to know your views of that, because it doesn't strike me as obviously correct that a supply chain that is fully within Canada, for example, is a safer supply chain than one that is, you know, globalized. I can see the argument for diversifying a supply chain, but I'm not sure about domesticating a supply chain, although I think the politics is going to push to domesticate them. So do you have views on this? Am I right? Am I wrong?
I completely agree. I think, you know, it's an interesting case, this one, because it's a global shock. So of course, if you have, you know, global chains is going to be disrupted. There's no there's no way to hide in a sense. But let's say you have other shocks going forward that are more localized than having a global value chain and maybe the ability to switch. I think that's what companies will want to have now, the ability to switch suppliers. They want to have more options in case. So I think if shocks are more localized, then having global supply chains make a lot of sense, just in terms of diversification of your production.
Yeah, I would agree. Diversification rather than domestication, but yeah, just making sure that you have options.
But having options, I mean, if you have a 10-stage supply chain and now you want an option at each stage, what you're really doing is building bigger supply chains effectively. You've got a plan A and a plan B at each stage along the way. You probably end up with a more globalized supply chain to get that greater diversification.
Well, there are two things. Of course, insurance is costly, so that's what you so that's an insurance policy basically, and that has a cost. You'll see this, I think, with bigger firms. We know, like around here, the tech firms are looking at multiple suppliers. We know Walmart has the ability to switch suppliers relatively fast. Smaller firms, that's going to be more difficult to do.
Danielle?
I'm just going to add that, domesticating your supply chain also can add significant costs. So, you're sort of, by cutting yourself off to all the options available, you can increase your costs quite significantly. So anyhow, it's not that it's necessarily, that's not necessarily the better option.
Well, I think this is going to be one of the interesting discussions and debates that we have in the next few years, is the extent to which the problem here was globalization. And if you really argue that the problem was globalization, then you're going to hunker down behind national borders. If you think the problem, I mean, it may well be the case that this pandemic spread more easily than it otherwise would have because we live in a globalized world, but nonetheless, there are still enormous benefits from globalization. And so the challenge is to get, all the benefits you can from a globalized world, but protect yourself in the way you need. So again, back to Sylvain's point that insurance costs money, right? It costs money, and we just got to keep that in mind. Let me ask a question about a green recovery, because this is one of the questions that came in the audience Q&A. Is there, we're starting to now hear discussion of the need for green stimulus. So there's two things in there. One is, do we need stimulus of the normal type? And the second question is, does that stimulus need to be, or should it be, green? So Danielle, you want to start us off on that?
Well, I'm curious to know what Sylvain thinks about that. Because central banks have started to wade into this arena. And I mean, I can share my personal views, but I would be curious to know what your thoughts are.
Right. So in terms of central bank and climate, so clearly, like, central banks are much more interested than they were in the past about this, because it's going to affect the economy, and so we have to at least be cognizant of how it works. I mean, in terms of for us, for instance, at the central bank, we're very restricted in the terms of assets we can buy. So there's this idea of, for instance, at the ECB, of maybe buying bonds from companies that are using cleaner energy than dirty energy. We couldn't do this at the Federal Reserve, because we can only buy treasury bonds and agency debt, and so that limits what we can do. In terms of government, so I think going forward, we're likely to be in scenarios where you'll need more stimulus, and fiscal policy will have to play a role in this. I think in the US, the probability that we see this being tilted towards green sector is little. I think, like, you could see, it'd be great to have money channeled to the states. The states' budget are in dire straits right now. You could sort of see federal spending toward greener investments. I think it's relatively unlikely. What's interesting that this crisis does now, and Chris, you noted that at the beginning with the large budget deficit and increase in debt that we'll see, at one point, we'll have to deal with that. And we'll have to consider either a spending cut or tax increase. And so maybe in some countries, a carbon tax might become more viable politically than it was a few years back.
Yeah. Well, it's a carbon tax is if you want to view it as a revenue generator, you can take that argument. But it's, as you saw in Canada and as we've seen in other countries, a carbon tax is not an easy thing to sell politically. I mean, I will be the first in line to say why it's a great policy, but it's not easy to do politically. It'll be interesting to see what happens in the United States in terms of support along in that direction. Danielle, your view of green recovery?
I was just going to mention that I think, a lot of the so, I mean, pollution levels are down right now. Like there's a lot of actually positive environmental impacts of this shutdown. So what I was going to also say is that, that we can think about some of these practices. So we've now, we know that a number of companies have announced that their employees are now entitled to work from home forever, right? Like Shopify, Twitter, Facebook, I think, many prominent technology companies. And so there may be some natural benefits to the environment of some of this crisis situation, that people realize that it is possible to do this kind of it is possible to work under these circumstances, and that's going to have environmental implications as well as implications potentially for real estate, housing markets, and so on in terms of where people live and all that kind of stuff. So there could be some positive environmental outcomes, and I guess I guess we have to just be careful when we're talking about stimulus policies and so on, try to meet too many policy objectives at the same time. And we need to make sure that people are going to be there's going to be some way of making sure people are able to recover and have good economic prospects going forward. So I would just say that we want to make sure we're not trying to do too many things at once.
Well, and this is an important policy lesson, is that you've got to make sure that you identify what the problem is you're trying to address, and then choose a policy instrument that actually can deal with it. And the idea that if you've got Jan Tinbergen's Nobel Prize winning idea, if you've got 10 policy objectives, you actually do need 10 different policy instruments to address them, and figuring out which one is the right policy instrument for each objective is a subject for a future webinar. We folks are out of time. We've got to bring this to a close. I just want to thank the two of you very much. Sylvain Leduc, thank you very much for being there. We had some technical issues at the beginning, but we brought it home. I want you to know that we in Canada would like you again to return to your home country. We would like the benefit of your wisdom, whether you are at our central bank or any place else. We look forward to the day when you return from San Francisco and you come back to the Great White North. But thank you for being with us today. Danielle, thank you very much for giving us some of your newfound wisdom about high frequency real-time data. I think it's wonderful stuff. Thanks to both of you for being here today. It's great for us to see that McGill grads are out there in the world doing great things. And the last thing I'm going to say is a bit of advertisement for an upcoming McGill virtual event. On June 4th, we've got Henry Mintzberg from the management faculty. And I don't know what his topic is, but Henry Mintzberg is always interesting. So Sylvain, Danielle, thank you very much. And everybody else out there, thank you for joining us. And we will wish you the best for the next few weeks in the pandemic. And we'll see you on June 4th for Henry Mintzberg. Thank you all.